Hello again everyone, and welcome back to the channel. In today's video we are going to be continuing our series of offsets. Today's video is the government pension offset. So we're going to be going over what that is, when it's applicable, and how it's applied. Make sure to watch the video in its entirety so you don't miss any small details that could pertain to you, so that you're not surprised when you go to file for Social Security benefits, no matter what it is that you're filing for. So government pension offset, what is it? It's an offset used for a specific set of benefits that you file for with the Social Security Administration whenever you're eligible for a pension that's not covered under Social Security taxes. So like the example that we used in the windfall elimination provision video, let's say that you are a teacher in Ohio and you are paying into the teacher's retirement system there, which is a private pension system. That means that there are no Social Security wages or no Social Security taxes that are coming out of your paycheck. So everything's going into that teacher's retirement system. Okay? And then after a certain period of time, you'll be eligible for a pension. And then let's say for the purpose of this video, you are actively drawing that pension, meaning that you've retired from that employer and you filed for a monthly benefit from them through that pension system. Then let's say that you have a spouse and all of their work is covered under Social Security and they're eligible for Social Security benefits. So when GPO comes into play, it's because you who have work that's not covered under Social Security are filing for benefits under somebody else's record. So maybe as a spouse, a divorced spouse, a widow, or a divorced widow would realistically be the situations that you would have this offset come into play. So let's, as an example, say, now we'll jump into how it's calculated and applied. So let's say that your gross monthly pension amount from your prior employer where you did not pay Social Security taxes was $3,500 a month. The way that GPO is calculated is they're going to take your gross monthly pension. Gross is before any, like if you maintained your health insurance through them and they take a deduction out for that, if you have voluntary tax withholding, all those things are deductions, but Social Security goes by your gross amount before anything comes out, right? So let's say that it's $3,500 a month you're getting. The GPO formula is fairly simple. You're going to take whatever that number is, you're going to multiply it by 2, and then you're going to divide that next number by 3. So in this case, if you had a $3,500 pension from non-covered employment, Social Security is going to offset whatever benefits you're eligible for by $2,333 per month. So let's say that you went to go file for benefits as a spouse. The most that you can receive as a spouse is 50% of the person's insurance amount. So let's say that your spouse's insurance amount was $3,000. Half of that would be $1,500, which is what you would be eligible for if you were at your full retirement age. If you tried to apply for it sooner, that $1,500 would be reduced month by month. All right, but let's assume that you're at your full retirement age and you apply for it, right? So you have that $1,500. Well, now we have to consider that offset, which is $2,333 based off of that $3,500. So you're going to be in the negative at this point, and that means that you'll be in a non-payable status. So if you proceeded with that claim, you would get an award letter from Social Security after they complete everything, basically saying you're now entitled to monthly spouse benefits, but we cannot pay you at this time because of your non-covered pension, right? So that would be a situation which is actually fairly common, because when you have, if you have a long tenure with whatever employer you had through that non-covered pension system, those pensions are usually pretty killer. And you'll draw much more from that realistically than you would from Social Security, in the sense that if it's a well-managed pension system, there's a smaller amount of people constantly contributing to that pension system, and an even smaller amount of people who are retiring with it. Right? So the way that pension systems usually work or fundamentally work is the people who are working are paying the people that are retired, right? Is how that works. So when you put that on a bigger scale, for example, federally, that's what the Social Security Administration is, right? So, and again, your wages are going to be vastly different throughout the nation than you would, scaling it down to a state like, Ohio, or no matter what state it is, it's still a smaller scale than federally, right? So normally, again, pensions with a full, work history of 20, 25, maybe 30 years of work are going to draw a significant pension amount. I've seen some that are in like $5,500 a month, $6,000. The highest I ever saw was about $11,000 a month, and I can't remember what the person did. But anyway, so that's how you would calculate it. Now, if you're going into the office and you have that conversation, right? The person that you're speaking to, the claims adjudicator or decision maker, whatever you want to call them, the representative, they're going to be interviewing you, and they might do pre-interviewing questions, right? So if, let's say, you and your spouse are in the office or you're over the phone, maybe before they start anything, they start asking you these questions about your work history and things like that, and then you bring up the pension. They might persuade you not even to file a claim, right? So they'll say, oh, well, based off of this $3,500 pension and what you're eligible for as a spouse off this person's record, it doesn't look like we would even be able to pay you. So, they'll be very casual and like, oh, would you just rather not file and go through it, or what do you want to do, right? And they'll put the ball back in your court, which they should not be doing, right? They should take that claim and make a decision. So if you were in a position where you were persuaded not to file and you didn't do that, well, if they're let's say later, there was a change in the law or the way that the offset was calculated, or something changes where you could go into a pay status, you want to make sure that you're on that record and ready for that change so that you have to do nothing later, right? You don't have to worry about contacting them when that change happens and then at that point getting on the record and all that stuff, right? That's a very bad habit, and realistically that's a lazy employee is what you're dealing with at that point. So what you want to do, even if they tell you that you're in a non-pay status, is you still want to file that claim and be on that record, whether you're eligible for that payment or in this case not. Because if there is that change or there's a change in the circumstances, then you might go into, you would automatically revert into a pay status because of that change. So in this case, or for another example, let's say that you did file the claim and you were on the record as a spouse, but you were in a non-pay status, but then your spouse passes away. At that point, what you're eligible for has changed as well. So again, we use the example of your spouse's insurance amount is $3,000. So the most that you could receive as a spouse from that person is $1,500. They pass away. Let's assume that they filed at their full retirement age, so there's no reduction of benefits. There's no retirement limitation, which would restrict what a spouse would be eligible for in the event of death if the primary wage earner took it early. And now that spouse is eligible for $3,000 at that point. So here's what you would do: 3,000 minus that 2233, right? So now the spouse goes from being in a non-pay status. Their benefits, if they're already on the record, will be converted automatically to a widow, and now they'll be eligible for that $667 payment after that person has passed away. It could be even higher. So let's take it a step further and say that your spouse waited until 70, right? So if no matter how long a person waits to file past their full retirement age, it's always important to note that a spouse is still only eligible for 50% of the insurance amount, right? So at your full retirement age, you might be eligible for $3,000 a month. Let's say that you waited till 70 and you generated that approximately, it's somewhere around 28%, right? So that's an additional $840 plus $3,000. That puts you somewhere around $3,840. Half of $3,840 would be $1,920, right? This is where a lot of people get confused. Again, your half is not, as a spouse, your half is not based off of 3840, it's based off of 3,000. So even if the person waited till 70 to file and they're generating a gross of 3840 a month and their spouse is eligible, that spouse is only eligible for half of that 3,000, not half of the delayed retirement credits. It's half of the primary insurance amount. So again, for this next example, let's say that was the case. As a spouse, the primary wage earner waits till 70. Their insurance amount is $3,000. Well, at 70, it goes up to $3,840. They file for benefits. Now, the person who has the non-covered pension also files as a spouse. The most that they're eligible for is $1,500 at their full retirement age. They have a $3,500 non-covered pension, which means that they'll be in a non-pay status. So let's say that at 71, right, the spouse passes away, the Social Security recipient passes away. The same formula would apply. So again, if what's going on with my calculator? Okay, so 3840 minus the offset amount. Now, again, depending on what the wage earner for under Social Security did would determine what that person's eligible for. So if they waited till 70, they got the delayed retirement credits, they later passed away, the whole time the spouse was in a suspended status, then now they're a widow, the benefits are going to convert automatically if they're past their full retirement age, and this would be your payment if that was your approximate situation. And now you're getting $1,500 a month plus your non-covered pension as well. Again, let's say that's $3,500, so 15 plus 35. So now you're at $5,000 a month. And before, right, maybe that person had 3840 minus, just thinking of total income for the house of when everybody was still alive, 3840 plus your $3,500 pension, that's 7340. So it's still a little bit less, a bit less, I should say. But that's the difference in the way that people file and kind of how it can make a difference depending on your circumstances and the situation of your work history, when you filed, how old you were, when you took benefits. It's probably a better way to say it. If there's any restriction on the record and pretty much everything that we just covered. As far as any sort of way to remove GPO, the only way to do that is if we scroll down here. It basically talks about the last 60 months or the last 5 years of your non-covered work, if you and your employer, so whether that is the state or the county or the city, wherever you're working, if the last 60 months of your employment also includes Social Security taxes being taken out, then that could be a situation where GPO does not apply to you, either as a spouse or as a widow or divorced spouse or divorced widow. So if you're getting towards the end of your career in that position, I would probably suggest talking to whoever is in HR on on ways that you might be able to do that to avoid an offset if possible. So that could be a tremendous help as well. And if you need a reference, the policy that describes this more thoroughly is GN 02608.170, exemption for last 60 months of employment covered under Social Security. So again, this is where in that last 5 years of employment, you might be paying into that private pension system, but maybe you're already paying Social Security taxes, or you sign up to have Social Security taxes paid as well. So definitely look into that, review this policy, and take it to your HR representative to see how you can have that applied if it's something that you're interested in. It seems like that would be very worthwhile to go ahead and pay those Social Security taxes. That way, when you go to draw Social Security, potentially as a spouse, which realistically you could do, because if all of your work was not covered under Social Security and you're not insured yourself, but your spouse is, then I would say in the overwhelming majority of those cases, you would be able to draw a benefit. So Again, make sure that you review this policy, that you go over it with you and HR at your employer. And again, it's talking about the 60-month exemption applies to individuals who either file for Social Security spouse's benefits on or after April 1st of 2004 or retire after June 30th of 2004. And then it will list all the applicable policies. And then it looks like it gives a couple of examples here as well. And then it even breaks it down to determining a month of credit towards the 60-month retirement. So just keep in mind, I believe that if you go, let's say you only have 59 months as an example, so out of that 60-month period, maybe one of those months you don't do it, I don't think it can apply to you. So it's kind of all or nothing in regards to this policy. So I hope you enjoyed today's video. If you got something out of it, you learned something, please give it a like. There's a bunch of other people out there looking for similar information, and when you like the video, it helps the algorithm spread this video to those people seeking the same information. If you had a question about anything that I covered, please leave a comment down below, and consider subscribing to the channel and turning your bell notifications so that you're always notified whenever I'm posting new content. If you're seeking any sort of professional help, you can visit my website at www.socialbenefitadvisors.com and schedule a free consultation, and we can go over your situation or your concerns and figure out how to build a Social Security plan for you so that when you go to retire, everything's good to go and there's no surprises. Thank you so much for watching the video. I hope you enjoyed it, and stay tuned for more.